Very good morning, all the participants. Today, let us have an overview of the startups. So, we'll be focusing on northern region to begin with, and then based on feedback, we will move to other parts of India also. So, let me share my screen with you first. I hope my screen is visible. Just a Yes. So, startup guide for Northern India. Why startup now? India's startup ecosystem and opportunities available. Entrepreneur self-assessment, basic information we will be needing from the client. Business planning essentials, structure, model, financial projections. Legal setup and compliances like registration, GST, labor laws. Central government schemes, Startup India, MSME, PMMY and many more. State schemes, particularly for Northern India, Punjab, Haryana, HP, UP, Uttarakhand, Delhi, J&K. Then bank finance and priority sector lending, term loan, CGT, MSC, Mudra, SIDBI, NBFC, venture capital and angel funding, NABARD, SIDBI, startups, equity funding. Then pitch and documentation, business plan, pitch deck, due diligence, and then action plan and next steps. So milestone road map for first 12. So this is the basic table of contents which we will be discussing in the next 1 hour to 45 minutes. So what is the India's startup ecosystem? 2.35 lakh DPIIT recognized startups. Third largest startup ecosystem globally. 131 unicorns. $392 billion combined valuation. VC funding raised January to June 2006 is $8.05 billion. Jobs created by startups 23 lakhs plus. And active startup policies in India 28 states. Why Northern India is a startup powerhouse? So Delhi NCR, India's second largest startup hub, home to 40 plus unicorns, including Zomato and so many others. Just a minute. So India's second largest startup hub, home to 40 plus unicorns, including Zomato, Paytm, Oyo, Policybazaar. Punjab and Haryana are strongly agricultural based. So agri-tech, fintech and manufacturing ecosystem with proactive state policies. Uttar Pradesh, largest state by population. ODOP scheme drives district level entrepreneurship. Then Uttarakhand and Himachal Pradesh, tourism, wellness, herbal, pharma startups with ecosystem incentives. Then Jammu and Kashmir, J&K startup policy 2021, highest incentive levels, central special category benefits. Chandigarh and Mohali, IT parks, incubation centers, proximity to IIT Ropar, then PEC, NITTR, and Rajasthan, iStart, Jaipur ranked among India's top startup cities, strong IT and handicraft sectors, strong connectivity, cross-border trade opportunities, growing tier 2 startup ecosystem. So this is why we have focused presently on Northern India. Now, why startup now? Let us understand the opportunities, economic landscape, and government push for entrepreneurship. First of all, let us have a look at the economic environment. As you know, India is the fastest growing major economy at 7% plus GDP growth, creating massive domestic demand. Then Digital India initiative is there, 900 billion internet users, fastest growing smartphone market. UPI processed 200 plus trillion rupees transactions in financial year 24, enabling digital businesses at all levels. Make in India and PLI schemes, rupee 1.97 lakh crore production linked incentives across 14 sectors. Government e-marketplace, GEM, startups can directly sell to government buyers. Young demographic dividend, so median age is 28 years. 65% population is below 35 years and largest consumer base is there. Then rising disposable income in tier 2 and tier 3 cities, new markets emerging in northern India, and post-COVID recovery, accelerated adoption of edtech, health tech, agri-tech, and logistics tech. So this is the economic environment for startups presently. Now, what qualifies as a startup? DPIIT definition, which is changing from time to time. So if you are incorporated as a private limited, LLP or registered partnership, not more than 10 years have passed from the date of incorporation. Annual turnover is not exceeding 100 crores in the previous years. You are working towards innovation or improvement of products, processes or services, and you must have potential to generate employment or wealth creation. And you have not done it, it is not a startup if you have formed it by splitting up or reconstructing an existing business. Suppose you were earlier running a proprietorship concern. Now you have converted into a private limited company, but all the assets and liabilities as it is have been transferred to the private limited company. Then you may not qualify this criteria of startup, right? Because it will be just a shifting. So it will be presumed that you have done it by splitting up or reconstructing an existing business. Then DPIIT recognition via Startup India portal is mandatory for benefits. You are eligible for tax exemption, IPR fast tracking, funding access. State level startup definitions may vary. For example, UP allows up to 25 crores, 7 years. And social enterprises and NGOs may have separate definitions under state policies. So this is the basic you have to remember whether you are qualified as a startup or not as per DPIIT norms. Now choosing your business entity, because the business entity decides your liability, your tax structure, your compliances, and what you are best suited for. So depending upon, ranging from sole proprietorship to company, all these things vary. And sole proprietorship, you can start with almost zero, liability is unlimited, tax slabs is 30%, compliance is very low, and it is best suited for micro level business where basically you are all in all. Then partnership business, minimum capital very limited, liability unlimited, tax rate 30%, compliance is low to medium, but it is best for family or local business. Then LLPs, liability is limited, compliance is medium, but it is best for service startups because different people join together. Private limited company, liability is limited, tax rate is low, compliance is high, and it is best for venture capital or angel funded startups because whosoever is financing you would like to have a corporate form of business. Because if you see the foreign funding, so they will always look for corporate types of setup because they know that it is being managed at a ministry level also, right? So they always prefer. So if you are trying to go in for venture capital or angel funded startups, then better start from a private limited company because once you have chosen a particular type of setup and then you decide to change, then it also has costs, right? And there may be a year where you have to comply with both the norms. Then OPC, compliance is medium, but best suited for solo founders. And Section 8 company, tax is usually exempt, compliance is high, and it is best suited for social enterprises. So depending upon the type of funding, depending upon the compliance, tax rates and liability, you choose a type of business structure accordingly. And be careful while selecting a particular type of business structure so that you don't have to change it frequently. So go with the long-term perspective. Then high opportunity sector for Northern India startups. The first basic thing you have to remember is that the education and health sector, they are the sectors where the inflows are liberal. You have continuous stream of inflows. So better going for a health tech or wellness startup. Then agri-tech and food processing also you can go in because incentives, lot of incentives are there. Then IT or SaaS or FinTech, and manufacturing and defense. So depending upon the sector where you have basic awareness, you have some contacts, you have some knack, you have some knowledge, you have some qualification. So in either of these sectors, you can go in, right? Like if you choose this agri-tech and food processing, then precision farming you can do, farm to fork models you can do, right? Mushroom farming, lot of people go in for this mushroom farming. Cold chain logistics, millet processing, Punjab 10,000 crore food processing policy, then PM Kisan Sampada Yojana funding available. So lot of things are available in agri-tech and food processing sector, particularly in northern India, say in Punjab, Haryana, UP. Now health tech and wellness, telemedicine, diagnostics, digital health records, Ayurveda, yoga wellness, HP and Uttarakhand is the niche market. Then Jan Aushadhi scheme, PM JAY scheme is there, supply chain opportunities, then rising senior care and mental health demand. So these are sectors where you can go in for startups. Then IT, SaaS and FinTech. Delhi NCR, 3,000 plus tech startups are there. Large talent pool is there. Mohali IT Park, Noida Expressway ecosystem. BFSI, SaaS, GST automation, compliance tech, and EdTech demand remains strong post-COVID. So these are the areas where lot of opportunities are there in NCR region. And manufacturing and defense. Defense corridor, UP, 50,000 crore investment target. PLI schemes, drones, electronics, pharmas, textiles, Rajasthan, gems and jewelry, cement, minerals, Haryana, automotive, autos, ancillary ecosystem. So depending upon the state, depending upon your qualification, depending upon your knack, right, you can choose either of these sectors. Now, what are the common myths and what is the reality? What are the common myths? Number one. So some of the common myths are you need a lot of money to start the business. You must quit your job before starting. Only engineers can build tech startups. You need a revolutionary idea to start. Funding is instant and only metros are viable startup locations. So these are some of the common myths. But the ground reality is many startups began with under 50,000 rupees. PMMY loans are available from 10,000 onwards. You validate idea while you are still employed and you transition only when runway is secured. So domain experts, if you are in agriculture, health, fashion, law, education, so you can also build great startups. Execution of a known idea is an undeserved market. So 10 times more success rate. 70% startups fail post funding due to poor execution. So it's not that only funding is the constraint. Despite funding also, your startup may fail if you do not execute it properly. So cash flow matters more than the funding. And reality is that Ludhiana, Jaipur, Lucknow, Dehradun, they are emerging very strongly in startup sectors. Now let us do some entrepreneur self-assessment. So basic information and questions we ask every entrepreneur before advising them. So this is a common checklist which will start with full name, age, gender and educational qualifications. Of course, your name should be as per PAN and as per Aadhaar. All these things are linked. Current occupation, number of years of experience, location or home district and current city of operation, because it is important for KYC norms also. Because if you choose a client, so that client should be genuine. Family background, any prior business experience in family, co-founders if any, their roles, experience, equity arrangement discussed, specific skills and domain expertise relevant to the venture, previous startups or business experience, whether you have been successful or failure, both things are equally important, and health and insurance status, personal and family. So these are some of the things we basically ask our clients before proceeding further. Number one, it serves as a KYC, which is very important before handling any client. And normally, you should prefer clients who come through some reference and not directly. Business idea assessment. Critical questions to answer. So, first of all, try to have an assessment of the business idea and how much ingrained it is in the mind of the startup founder. So what specific pain point does your idea solve? And who suffer from it? Market size, because you are a solution provider basically. So before starting as a solution provider, you must be able to identify the pain points which your idea is going to solve, and who is suffering, who are the ultimate consumers, how many people or businesses have this problem, local, regional or national market. Then existing solutions, because now also this problem must be being solved. So how is this problem being solved today? So what makes your solution better? So how you are one up better? Value proposition, what unique value do you offer? Why will customers choose you over other alternatives? Now, what is your revenue model? How will you make money? SaaS, product sales, marketplace, subscription, service fees. So what is your revenue model? Then scalability. Can this be replicated without proportional increase in costs? What are the fixed costs? What are the variable costs? Barriers to entry. What will stop a competitor from copying you in 6 months? Because today your idea may be new, but you are open to competition. Anybody can start. Lot of population is there in India. So what is your niche in this field? What will stop a competitor from copying you in 6 months? Then initial traction. Do you have any early customers, LOIs or prototype validation? So by this way, by having a one-to-one talk with the person who is intending to start a business as a startup, so this will help you in understanding his depth of knowledge and his willingness to start this project. Then financial profile. Questions for every entrepreneur, because own investment is equally important. So normally promoter's contribution, you may call it 20%, 25%, something is needed. So how much can you personally invest? Because unless you invest your own funds, you will not develop interest. Then expected total project cost, whether land or space is required, because land is quite costly. Then machinery, working capital, pre-operative expenses, land or premises, whether they are owned or rented. If rented, do you have a lease agreement for 10 plus years? Then machinery or equipment, make, model, cost, single or multiple quotes are obtained, whether it is imported or indigenous, right? Then working capital requirement, how many months of operations can you fund? 2 months, 3 months. What is the normal credit period in that industry in which you are going to do? Then break-even analysis, when do you expect monthly revenues to cover all expenses? Then tax registration status, PAN, Aadhaar, GST registration, obtained or needed. Then existing banking relationship. So which bank do you use? Any existing credit facilities? Any banking relationship your family members are having? So all these things are very important to assess the financial profile of your client. Then how much should a promoter invest? Funding norms, right? So normally, ideally, the promoter's contribution should be 25, anywhere between 25 to 33%. Mudra loans you can get from 50,000 to 10 lakh rupees. Then CGT MSE or SIDBI, no collateral is required, 10 lakhs to 2 crores. And then Startup India Seed Fund Scheme, 5 lakh to 50 lakh. So these are some of the fundings norms, but they will require at least 25 to 33%. And most of the schemes, they offer loans without collateral, because they also know that you are starting a startup, so you don't have much to offer as a collateral. But your business idea must be good and you should have a very clear vision. Then red flags in entrepreneur assessment. What advisors watch for? So CIBIL score, if it is below 650 or settled or written off loans. So this needs to be resolved before new funding. So all these things you first of all, before going to the bank, you do some initial soul searching. So what is your CIBIL score? Then no personal saving or investment capacity, purely dependent on others' money is a risk signal. Then vague or copy-paste business idea without any domain knowledge or market research. Then overestimated revenue projections without basis. For example, 1% of India's market is 100 crores. No registered entity or address proof for business. Delay bank processing significantly. Expecting funding before providing basic product market fit or getting first customer. Then founders with history of disputes, litigation or multiple failed ventures without learning. And then no GST registration despite being in business. So compliance gaps raise red flags for banks. So all these are things. So these are some of the red flags which you must be aware, right? Now business planning essentials: structure, projections, viability assessment, and DPR preparation. So what are the components of a bankable business? DPR, detailed project report. So executive summary, 1 to 2 pages, problem solution, market, team, funding ask. So the best way to prepare a detailed project report, detailed feasibility report, whatever you call it. So the first thing is you prepare an index. And once you prepare the index properly, then rest is fill in the blanks. So first of all is the executive summary. You describe in 1 to 2 pages what is the problem, what is the solution you are offering, what is the market, what is the market size, team you are having, and funding ask. Then company overview, entity type. Entity type we have already discussed, from sole proprietorship, LLP, partnership, Section 8 company, different type. Entity type, registration details, promoter background, then product or service description, technical details, USP, IP ownership, certifications needed, market analysis, right? So competitor analysis, target customer segments, then marketing and sales strategy, operations plan, management team, financial projections. So you should have 3 to 5 years profit loss count, balance sheet, cash flow, CMA data for banks. Then funding requirements, total cost, promoters contribution, loan amount, then purpose wise breakup, and risk analysis and mitigation. So SWOT analysis, market risk, financial risk, regulatory risk. So these are the components of a bankable business plan, right? Now financial projections. So this is the standard format, and you should be aware that the ratios, the DSIR, normally they prefer 2 or at least more than 1.5. Now key financial ratios. So you have to see that these financial ratios are as per the norms if you are trying to go in for funding. Then CMA data, right? Legal setup and compliance, company registration, GST, licenses, IP protection, and key compliances, right? So DSC and DIN, directors, they get digital signatures and DIN. Even in case of LLPs, these are required. Then name approval, and then SPICE form, then this certificate of incorporation and memorandum of association, bank account, registration. So all these things are required. In some states, even professional tax registration is required. Then mandatory registrations, right? So PAN is necessary, mandatory for all tax purposes. Then GST registration is mandatory if your turnover is exceeding a particular limit. And if you are going for projections, then better going for GST registration from the very beginning, even if your turnover is below the taxable limit, because it encourages you to become tax compliant. Then Udyam registration, it is very necessary. And you know, it is all free online registration at udyamregistration.gov.in, because it unlocks all MSME benefits. Then FSSAI license if you are into any food or beverage business. Then central or state license based on turnover. DPIIT Startup India recognition. You apply free at startupindia.gov.in within 10 years of incorporation. Then trade license or municipal certificate from local body. Professional tax registration. It is state specific, applicable in Punjab, Haryana, Gujarat, etc. Then ESI registration if more than 10 employees. PF registration if more than 20 employees. So a lot of registrations are required. So these are the mandatory registrations, and it is advisable that you go in for ESI and PF also from the very beginning, even if the number of employees are low, because that way even you will be able to encourage proper employees, proper workforce, right? Because you can say that, okay, our company offers ESI and PF registration also, all right? ESI and PF benefits also. And then if you are GST registered, so then naturally you will be able to maintain proper accounting records also as per the mandate of GST. So GST registration and compliance for startup. So this you can go through on your own. And in case your business is export oriented, then you can have some benefits. Intellectual property protection. So trademark, patent, copyright, design, trade secret, and then DPIIT recognized startups get facilitated IP services, rebate in fees, and faster processing at all IP offices. So tip is register trademark before launch. Registering post-launch may face objections from similar prior marks. So before the launching, you get your trademark registered. Now central government schemes. So what are the various central government schemes? Let us have a look. Startup India. And what are the core benefits of DPIIT recognition? So a lot of benefits are there, right? I have given you all the benefits. You can go in for this and you can write to me in the comment box for this PPT so that you can go it on your own. Startup India seed fund scheme is there. PM Mudra Yojana is there. CGT MSME, MSE scheme is there, wherein the government guarantees, right? And so instead of offering collateral, the government guarantees is there for micro and small enterprises. Website address I have given. Then key MSME ministry schemes you must know, right? Credit linked capital subsidy, Prime Minister's employment generation, Z certification subsidiary, Udyam Assist platform, MSME champion scheme, procurement policy, NSIC, trade receivables discounting system, TREDS. So these are the various facilities. These are various MSME schemes which you must know. Then PMEGP subsidy rates and eligibility metrics. So these are the subsidy rates which are different for different categories, for general categories, for special categories, right? So special categories you get lot of benefits. Maximum project cost, then promoters contribution, and then balance bank of loan. So normally bankers will provide 65 to 80%, right? Now production linked incentives, PLI schemes are startup opportunities. National Startup Awards and Recognition Schemes. So these are the various schemes. Now some state schemes are there for Punjab, Haryana, HP, Uttarakhand, Uttar Pradesh, Delhi, JK, and Rajasthan, and Leh and Ladakh also. So whenever you want to study these schemes, go to the state government's website, wherein all these schemes are displayed. So I have given you a chart for Punjab, Haryana, Himachal Pradesh, Uttarakhand, UP, Delhi, J&K, and Rajasthan. So Punjab Startup and Innovation Policy, detailed benefits. Punjab Industrial Development, additional support mechanisms. Haryana Startup Policy. Himachal Pradesh Startup and Innovation Policy. Uttarakhand Startup Policy. Uttar Pradesh Startup, because depending upon the state, initially your client may not have presence in all these states. So depending upon, this is basically going to be an awareness video for the benefit of professionals and entrepreneurs as well, that depending upon the state you are in, you can study that individual policy and benefits. UP, one district, one product. Then Delhi Industrial Policy, J&K Startup Policy, Rajasthan iStart Startup Policy. Then seed grant comparison. So I have given a seed grant comparison also in rupees in lakhs. So who are the highest offerers? Delhi and Haryana. And then followed by J&K and Himachal. And thereafter Punjab and UP. Right? So these are the seed grant comparison in lakhs. Now how to apply for state startup schemes? What is the general process? First of all, you register the entity, either a private limited or LLP or OPC or partnership in the target state, right? First of all, you will have to identify the target state. Then DPIIT recognition, state registration. So register on state startup portal also, like Invest Punjab, Start UP, HRY Startup, apply to incubator. So submit application to empaneled incubator or DIC for seed fund, and then pitch or screening, and then disbursement. Then special benefits for hill, northeastern and border state like J&K, Himachal Pradesh and Uttarakhand. Now bank finance and priority sector. As you know, besides the state government funding and central government funding, banks are also funding the priority sector. So they are offering term loans, working capital, CGT, MSE, Mudra, SIDBI and PSB schemes. So Indian banking ecosystem, who lends to startups? Public sector banks, regional rural banks, private sector banks, small finance banks, SIDBI, NABARD, and this NABFID, MFIs and NBFCs, all are offering to startups. Types of bank loans. So I have prepared a chart. Okay, what are the various types of loan facilities which the banks are offering? Then SBI, MSME and startup schemes. PNB and BOB, MSME and startup products. And Stand Up India, SIDBI, Small Industry Development Bank of India, NABARD, and step-by-step process applying for a bank loan for an MSME or startup. First of all, you prepare the DPR, prepare a project report, CMA, financial productions with the help of a professional. Then choose your bank and scheme, submit the application, then technical appraisal. So bank may depute officer or hire valuer for site inspection, then sanction letter and documentation and disbursal. So the most important point here is disbursal, because sometimes you reach up to the sanction letter level, but disbursal is the key, right? Then documents required, KYC of promoters, business identity. So all these things are required at the disbursal level also. Interest rate benchmarks I have given for various types of schemes, which range anywhere from 9% to 12-13% also, right? So depending upon your category, you can choose. And now NBFC, venture capital and angel funding. So as I told you in the very beginning, for this venture capital and angel networks, they always prefer a corporate form of structure, like an LLP or a company. So India startup funding landscape, equity funding stages for startups. First of all, pre-seed is there, then seed, and then Series A, Series B, Series C, and then IPO or exit. So exit route is also very important, which is to be discussed, right? Then leading VC funds active in Northern India or Pan India. So these are some of the funds which are active. Then angel investors. So what angels want? They want strong founding team with domain expertise, large addressable market, right? Then working MVP or at least a validated prototype, then early customer traction or letter of intent, clear and defensible competitive advantage, founder commitment, realistic financial projections, and exit potential with 5 to 7 years. Because normally the exit period for venture capitals is, venture or angel investors is 5 years. So they want to exit after a period of 5 years. Then top incubators and accelerators in India, alternative and emerging funding options for startups, crowdfunding, revenue-based financing, CSR and impact funding, and supply chain finance. Then semi-regulated funds are also there, startup valuation, then pitch and document preparation. So business plan, pitch deck, due diligence, readiness, and investor communication. So these are the things. So whenever you want to pitch in, you prepare a 10-slide presentation, company purpose, one-line definition of your startup, like a tagline. Test it on a 10-year-old. Problem, the specific pain, who feels it, how often, how much it costs, then solution, why now, why timing is important, then market size, competition, product, business model, team, and financials plus art. So all these things are very important. आजकल तो टीवी में भी एक प्रोग्राम आता है जिसमें बहुत सारे स्टार्टअप्स आते हैं, उसको देख के भी काफी आइडिया लग जाता है। वो 2-4-5 मिनट में अपना प्रेजेंटेशन देते हैं कि हमारा प्रोडक्ट क्या है, हमें कितना आस्क है, ये सब चीज। Then 10 common pitch mistakes that kill investor interest. Number 1, saying we have no competition. ऐसा तो कोई है ही नहीं प्रोडक्ट कि आपका ही प्रोडक्ट है। एवरी प्रॉब्लम हैज अ सॉल्यूशन, योर कंपटीटर इज द स्टेटस। ठीक है, वो तो हमेशा रहेगा, नहीं है तो पैदा भी हो सकता है। देन 1% ऑफ $1 billion मार्केट है ना, 100 crore रेवेन्यू, नो बॉटम अप जस्टिफिकेशन, इन्वेस्टर से टॉप डाउन मैथ। ठीक है, then founder heavy team with no key management depth. So who runs operations when founders focus on growth? No clear ask, we need funding is not a pitch. State exact amount and specific use of funds. Then 5-year projections with 200% CAGR but no justification. Show the assumptions behind every number. Then spending first 10 minutes on the problem, not the solution. Get to your demo by slide 3. Not knowing your burn rate, runway, or unit economics. So these are the first questions investors ask. Then ignoring the exit strategy. Investors want to know how they will get their money back. Then founder ego in question and answer. Never say that's a great question, but you clearly don't understand. Then overly technical jargon. If your investor can't explain your business to a friend, you have lost the deal. So these are some of the things which may kill the interest of the investor in your project. Now, investor due diligence is also important. Documents to keep ready. So these are the things. Then one page business summary, executive summary. Negotiating with customers. What are the do's and don'ts? Tips for successfully applying for government grants and schemes. Then 10 startup failures and how to avoid them. Action plan and next strategies. So best to learn out of this is that don't spend too much on fixed costs, right? So if you spend on fancy offices before earning any revenue, so work from home, co-working, incubators first, hiring too fast, too soon, contract or freelance first, permanent hire only when role is proven necessary, then ignoring unit economics. So these are all the points you can go through on your own. These are the startup failures and how to avoid them. Now action plan and next steps. Your 12-month startup milestone roadmap and next immediate actions. So what should be the roadmap? In the first 2 months, you should go in for validation. You conduct 50 plus customer interviews, validate pain point, identify the ICP, ideal customer profile. Then month 2 to 3, entity and compliance. Month 3 to 4, MVP development, build minimum viable product, use no code tools, freelancers to reduce costs. Month 4 to 5, beta launch to 10 to 20 early users, gather feedback, iterate weekly. Then month 5 to 6, first revenue, target first paying customer. Month 6 to 8, seed funding preparation. And then month 8 to 10, scale first cohort. And then month 10 to 12, fundraise or next phase. So these are the 12-month startup milestone roadmap. Your first 30 days action plan. So first of all, obtain the registrations, right? Research and choose the correct entity type. Open a separate bank account for business. Register on Udyam portal. Apply for GST registration. Visit nearest district industry center. Get information on state-specific schemes. Join local startup community. And identify and visit 2 to 3 empaneled incubators in your city to understand the application process. Now, quick scheme finder. Match your profile to the right scheme. So, depending upon your profile, you go in, you select the best scheme, what and where to apply. So, I have given the links also. Essential government portals and helpline numbers. So, I have given all the numbers of various schemes. State startup portals. I have given the state startup portals links also. State portals. Tax planning for startups. So tax planning is also very important to show. GST compliance. 4 new labor codes. So you should have a basic idea. And you should have a clear idea about the minimum wages also. You should have an idea of the POSH compliances also, because it is very important and penalties are quite heavy. Then startup ecosystem map. Depending upon the state. So map your ecosystem. Women entrepreneurship, there are special support ecosystem. SC/ST entrepreneurs, special schemes and supports are there. NRI and diaspora investment scheme in Indian startups. ESG and sustainability. Essential digital tools for early stage startups. Critical compliance failures that destroy startups. Inspiring startup success stories from Northern India. Zomato, Paytm, Oyo, Policybazaar, IndiaMart, Licious, Off Business, Business. And important events and deadlines for entrepreneurs. Annual calendar you should be having. Then build your mentor and network capital. So this way we have given our own profile also, that how we can help you in this. So what to bring it to your first consultation meeting? These are the documents you should keep handy. And the startup mantra. Solve a real problem for real people, not an imaginary problem for imaginary customers. Start small, but think big. One city, one product, one segment, master it, and then you scale it. Ship fast and iterate. A good product shipped today beats a perfect product never. Know your numbers, revenue, cost, margins, burn rate, ignorance of numbers, startup death. Then build your team before you need it. Culture and co-founders determine outcomes more than ideas. And use every rupee of available government support. Crores in schemes go unclaimed every year. Then war situation. What changed? So as you know, geopolitical timelines have changed. Trade and diplomatic changes are there. Economic signals and net impact for Northern India. So all these things also you should keep in your mind while starting a business. Then defense and security startups, UP corridor opportunities there, trade arbitrage, J&K and border regional opportunities, risks and cautions, and then updated sector priority mix for Northern India. Then Leh Ladakh Union Territory. It is offering strategic frontier opportunities in renewable energy, adventure tourism, border defense, and agri-tech, ODOP and UT startup incentives. Then drone or these UAV startups. So these are also very important, particularly in high altitude areas. Dried vegetables and mushroom startups are there. So I've given you a basic idea of these startups also. And these are our details. So this was a brief presentation about the startup schemes. So if you have liked the video, you can subscribe to our channel to get updates on more such videos. And you can request a copy of the PPT in the comment section. So we'll send you a copy on your email. Thanks for watching. Thank you very much.